Hey guys, so today I wanted to go into this idea about infinite banking and how it's tax free, and not just talk so much about all the other attributes of parking money insurance policy with just the uninterrupted compound interest, the liquidity, the guarantees, the creditor protection, the competitive rate of return. But I want to get into and dive into how infinite banking is tax free. So let's look at this little chart that I have right here for a second. And you can see here, I call this the insurance product spectrum. And so let me just tell this story. So in the past, over the time of history, not a lot of people have been using infinite. Well, I'm sorry, not a lot of people hear about infinite banking because it's just been designated as more of like a major wealth product for a lot of these very well-off families. They, as you know, banks park money in life insurance called BOLI, bank-owned life insurance. There's COLI, corporate-owned life insurance. So there's all these ways that these very wealthy individuals and institutions park money in these policies. Okay, so let's look at this for a second. You have this insurance product spectrum, like I said. So there's this. You have this on the left hand side. You see cash. Those are the arrows going up with cash, and the death benefit is at the very bottom. So we call that single premium insurance. And so that's what the Ray Krocs and McDonald's, the Walt Disneys, the Rockefellers, the Vanderbilts, all these really, really wealthy people used to go to insurance companies and they would say, okay, I'd like to put $20 million in an insurance policy. I'd like to buy $20,500,000 worth of insurance. But which means, so they're basically it's a tax shelter. They get these contractual gross, they have the guarantee returns, the liquidity of their cash, but they're buying only $500,000 of death benefit. So what came along is, of course, Uncle Sam gets in the way like he always does and says, look, guys, I understand what you're doing. It's a tax shelter. You're not paying the piper. You're not playing by the rules. Or they're playing by the rules at the time, but they weren't using it for insurance. It was more of a location to park cash and shelter it from tax. So what Uncle Sam did is he came up with this idea called the Modified Endowment Contract line, or the MEC line. That's right here, okay? So you can see on the left-hand side, there's single premium, which is all cash, no death benefit. And you see this taxable area on the left-hand side of the MEC line. And then we'll jump over to the right-hand side. And you can see here that this is all death benefit and no cash. And that's what a lot of people today look at and hear of and think of as insurance. They think of it more as just an expense. So I look at it at term is all death benefit and no cash. I mean, as you know, you're simply just, so you buy a 30-year term policy for $1 million and it's going to cost you, $300 a month or $300 a year or $400, $500 a year, whatever the number is. You're simply just renting insurance. You're not earning any cash value. Over time, though, then we started to create these hybrid products called Universal Life, which is like a 1-year term policy with a little bit of growth. And you got Index Universal Life, which is like another term policy, but then it's tied to the market. And you have Whole Life, which is where you're structuring, which is what we use for infinite banking. I'll show you how. But this whole life policy, as your grandfather's whole life, this would take about 20 years to build up how much you put into it in cash value. It takes a long time if it's structured more for death benefit than it would be for cash. So as you can see, this is way, way, way on the far right side of this spectrum here, and it's all death benefit and hardly any cash, but it's all tax-free. You see, so everything on the right-hand side of this MEC line is tax-free. So what we decided to do, and what we learned from our guy, R. Nelson Nash, who wrote the book, Becoming Your Own Banker, is he taught how to park money or park our policies and create our policies right up on the right-hand side of this MEC line. So as you can see, the farther we get close to this MEC line, we're getting more cash and less death benefit. So what we do is we park it right up in here, and it keeps everything tax-free. So we use this whole life product, but yet we flip it on its head. Instead of death benefit and no cash, we flip it and go all cash, hardly any death benefit. That allows Uncle Sam to keep everything tax-free. So as I say here, it's all about the insurance product and how you structure that product. We don't use Index Universal Life. We don't use Life or Universal Life. We use strictly Whole Life, because what we're doing with this Whole Life product is we're making it to where you're actually partnering with the insurance company. It's like if you go to Las Vegas, you're betting with the casino, and the house always wins. So these actuaries, they know how to structure these properly. And that's what makes these things so contractually guaranteed, and is because we do it. We park this thing with the insurance companies in these whole life products. So let me just go into this really quickly, and let me show you how we structure these products for long-term contractual growth. So I have this guy named Johnny Appleseed here, And the way that we structure these policies to make them these infinite banking policies and keep them tax-free is we have to make it look and smell and feel like insurance, okay? And so what that means is that we have to have in this very first year cash drag. As you can see, we've put in $15,000. We've only got access to about 10 grand in that first year. So roughly 65% of what we put in is liquid in the very first year. If you can think about this, if you can be okay with giving up only access to $6,000 in the first year, it's not gone, okay? As you can see here, it actually went to buy you $614,000 of death benefit, okay? So that's where that $5,000 extra goes. It goes to purchase death benefit because we have to keep it in this little box to make Uncle Sam happy and knowing that, hey, at the end of the day, this is an insurance policy. Okay, so over time, you build up. The next year, $15,000, we get access to about $15,000 immediately. So as you can see, we put all of the cost of insurance in the very first year. So over time, over the next 10 years, you put in $150,000, you got access to $162,000. Nothing crazy. I would be venturing to say that I don't think you can get $12,000 of growth in your Regions checking account. I would be willing to bet that doesn't happen. So let's turn this off. Remember what I said earlier. If you can give up access to that $6,000 in the very first year, if you're okay with that, look what happens in this policy over the lifetime of it, okay? Like I said, $12,000 of growth over 10 years, $100,000 of growth over the next 10 years, $237,000 of growth over the next 10 years. And it keeps going. $443,000 worth of growth. When you're 80 years old, you've gained $750,000 of tax-free growth simply because you parked money in a properly structured life insurance contract. I look at this and I think if I happen to graduate into the next life at 85, I've had $966,000 of growth, $1.1 million of cash value, and then when the day is done, $1.3 million of tax-free guaranteed death benefit that goes on to my heirs and my beneficiaries. So if you can, like I said, are okay with giving up access to $5,000 in the very first year of this policy, all of this growth is tax-free. All of it. Every dollar of this is tax-free. So when you pass, you've earned $966,000 of contractual guaranteed tax-free growth over your lifetime simply because you gave up access to $5,000 in the first year. Are you okay with that? Ask yourself that question. So that's kind of how we structure these policies. We don't use anything else. We don't use universal. We don't use index universal. We don't use term. Everything is 100% 200-year-old whole life insurance structured for cash and not for death benefit. If this is something that you're interested in learning more about, leave me a message below. Text me, email me. Let's get you on this train. You have to get started now because over time, as Tony Robbins would say, you can't build wealth through earning it or trading your time from it. You have to compound it. That's the only way that you can make huge guaranteed growth and wealth over your lifetime.